from Benjamin Graham?
Yes, I am.
Yeah, it's a nice book.
So the first thing I learned about the differences between investment and speculation.
According to Graham, investment consists of three equal parts. The first one is thorough fundamental analysis of companies in which you invest. The second one is deliberately protecting yourself against serious losses. And the last one is aspiring to educate, not extraordinary performance. Graham suggests two possible investment approaches. The first one is defensive. Second one is enterprising. The enterprising approach is physically and intellectually taxing, while the defensive approach is emotionally demanding.
And then the connection between inflation and investment.
You must understand inflation. Specifically, you must measure your investing success not just by what you make, but by how much you keep after inflation. Inflation is not going away, and it must always be factored into your risk analysis. Stocks tend to outpace inflation 80% of the time. To bolster your defenses against inflation, you can branch out beyond stocks to REITs, or Real Estate Investment Trust, and TIPS, or Treasury Inflation Protected Securities.
And then the stock market history.
It is a common mistake to forecast the future, specifically stock prices, exclusively by extrapolating the past. The reason why people fall into making this mistake are buying into the hype of strong bull market, trusting so-called experts too much and not doing their own homework, not staying humble about forecasting powers. The value of any investment is, and always must be, a function of the price you pay for it.
And then the last one is about the defensive investor principle.
Defensive investor principles. The decision about how defensive or enterprising your approach is should be based not on your appetite for risk, but rather on your willingness to put time and effort into your portfolio. Your risk appetite should not be based on your age, but on your circumstances. Are people depending on you? Are you self-employed? How much can you afford to lose? Graham insists that everyone should keep a minimum of 25% in bonds. That caution, he argues, will give you the courage to keep the rest of your money in stocks even when stocks sink. The more familiar a stock is, the more likely it is to turn a defensive investor into a lazy one. Buying stocks in tiny increments for years on end can set off big tax headache. If you are not prepared to keep a permanent and exhaustively detailed record of your purchase, do not buy in the first place. Don't invest in only one stock, or even just a handful of stocks. Graham's guideline of owning between 10 and 30 stocks remains a good starting point for investors who want to pick their own stocks. But you must make sure you are not overexposed to one industry. If, after you set up an autopilot portfolio, you find yourself trading more than twice a year or spending more than an hour or two per month total on your investment, then something has gone badly wrong. Do not let the ease and up to the minute feel of the internet seduce you into becoming a speculator.
So that's the thing that I have learned from this book. And then I'm just curious what other things covered by this book.
The next is talking about portfolio policy for the enterprising investor.
Portfolio policy for the enterprising investor. Day trading carries extreme risk. Avoid. IPOs are frequently overpriced. Avoid. Treat junk bonds with skepticism. Exercise extreme caution buying foreign bonds. Annual operating expenses should be no higher than 1.25%. A great company is not a great investment if you pay too much for the stock. The bigger firms get, the slower they grow. When price or earnings ratio go above between 25 and 30, then the risk is too high. Always be on the lookout for temporary unpopularity which enables you to buy a great company at a good price. The intelligent investor, however, get interested in big growth stocks not when they are at their most popular, but when something goes wrong. Diversify your portfolio. It is advisable to buy foreign stocks. You never know what the future will hold at home and abroad.
Also, it explained about the connection about the investor and market fluctuation.
If you want to speculate, do so with your eyes open. Knowing that you will probably lose money in the end, be sure to limit the amount at risk and to separate it completely from your investment program. A stock does not become a sound investment merely because it can be bought at close to its asset value. The investor should demand, in addition, a satisfactory ratio of earning to price, a sufficiently strong financial position, and the prospect that its earning will at least be maintained over the years. There is a paradox in that the more successful the company, the greater the fluctuations in the price of its shares. This really means that, in a very real sense, the better the quality of the common stock, the more speculative it is likely to be. The speculator's primary interest lies in anticipating and profiting from market fluctuations. The investor's primary interest lies in acquiring suitable securities at suitable price.
Bruce also explained about investing in investment funds.
Exploring research into investment funds, key points to take from this chapter are: the average fund does not pick stocks well enough to overcome its cost of researching and trading them. The higher a fund's expenses, the lower its returns. The more frequently a fund trades its stocks, the less it tends to earn. Highly volatile funds, which bounce up and down more than average, are likely to stay volatile. Funds with high past returns are unlikely to remain winners for long. Later in his life, Graham praised index funds as the best choice for individual investors. As does Warren Buffett that said, the chapter still explores mutual funds, and the things to look for when choosing one. Their managers are the biggest shareholders. They are cheap. They dare to be different. They shut the door. They don't advertise. The order you should look at a mutual fund the opposite way to how most buyers do it. 1. Fund's expenses. 2. Riskiness of the fund. 3. Manager's reputation. And 4. Past performance.
Another thing is about investment and the advisor.
This chapter deals with how to seek and select help with your investments. The major caveat with seeking a full-time financial advisor is that you need at least $100,000 to invest. Until you reach this point, Graham suggests low-cost index funds. In terms of selecting an advisor, the types of things you want to know about them are: what is your investing philosophy? Do you focus solely on asset management, or do you also advise on taxes, estate and retirement planning, budgeting and debt management, and insurance? Do you use stocks or mutual funds? How will you track and report my progress? Do you provide a checklist I can use to monitor the implementation of any financial plan we develop? Do you use technical analysis? Do you use market timing? A yes to either of the last two questions is a no signal to you. Other red flags include advisors who have fees that will consume more than 1% of your asset annually. Investors who promise an annual return higher than 10%, and advisors who will not show you their Form ADV. Security analyst for the lay investor, general approach and pre-share earnings. The purpose of security analysis is to estimate the value of a given stock, which can then be compared with the current price to determine whether or not the security is an attractive purchase. Graham makes it clear that any kind of security analysis which requires more than basic arithmetic and algebra is likely to be flawed or bogus. What should you consider to avoid overpaying for a company? Number 1. Long-term prospects. Number 2. Management quality. Number 3. Financial strength and capital structure. Number 4. Dividend record. Number 5. Current dividend rate. Stock selection for the defensive or enterprising investor. The enterprising investor approach is built upon the same foundations as that of the defensive investor, but with greater flexibility. Apply the various tests of quality and price reasonableness along the lines we have proposed for the defensive investor. But they, enterprising investors, should be less inflexible, permitting a considerable plus factor to offset a small block mark in another. Guidelines for the enterprising investor, similar to those for the defensive investor but slightly more leeway. Number 1. Financial condition. A. Current assets at least 1.5 times current liabilities. B. Debt not more than 110% of net current assets. 2. Earning stability. No deficit in the last 5 years. 3. Dividend record. Some current dividend. 4. Earning growth. Last year's earning more than those of previous year. 5. Price less than 120% net tangible asset. Convertible issues and warrants. Discuss the pros or cons of convertible bonds, investments which behave like stocks and work like options. You can keep the bond and earn interest on it, or you can exchange it for the common stock of the issuing company at a predetermined ratio. Wall Street salespeople often describe convertible bonds as a best of both worlds investment, but the intelligent investor will quickly realize that convertibles offer less income and more risk than most other bonds. Verdict: unless you are dead set on only holding bonds, convertible bonds aren't a great choice. Chapter 19. Shareholders and Managements. A stock split is a restatement of the common stock structure, presumably because lower price range will be more acceptable to old and new shareholders. A proper stock dividend is one that is paid to shareholders to give them tangible evidence of earnings. It is our belief that shareholders should demand of their managements either a normal payout of earnings on the order, say, of 2/3, or else a clear-cut demonstration that the reinvested profits have produced a satisfactory increase in per-share earnings. Chapter 20. Margin of Safety as the central concept of investment. Graham's concept of the margin of safety is built on arithmetic reasoning from statistical data, understanding the intrinsic value of investments using the techniques from earlier chapters. The intelligent investor must focus on getting their analysis right, but also on understanding and taking precautions against the inevitable event of making errors. In the ordinary common stock, both for investment under normal conditions, the margin of safety lies in expected earning power considerably above going rate for bonds. The margin of safety idea becomes much more evident when we apply it to the field of undervalued of bargaining securities. We have here, by definition, a favorable difference between price on the one hand and indicated or appraised value on the other. The difference is the safety margin. There is a close logical connection between the concept of a safety margin and the principle of diversification. For the margin guarantees only that he has a better chance to profit than for loss, not that loss is impossible.
Okay, besides the point that you explained before, what about other topics? Like margin of safety, the stock selection, the relation between the shareholder and management, and maybe about the margin of safety?
I think I know who is the person can explain you about this.
Hello. This chapter will talk about security analysis. We will see. Then we will determine whether the current price is overpriced or not. Some consideration can be evaluated. First one is about long-term objective of the company. Second one is about the quality of management. The third one is about financial health and its capital structure. Fourth one is about the record of their dividend for the past years and the current dividend price. And the next we'll see about the decision for defensive investor and how to gain from the stock market. We are now discussing about the next chapter. First one is about convertible bonds. It's a bond that it can be exchanged into common stock. As an intelligent investor, we will realize that convertible bonds is less income with more risky. Second one is about management and shareholder conflict. It's about dividend policy and how the management decided to give the dividend to the shareholder. The third one is about margin of safety. Margin of safety, it can be applied to undervalue, and we'll see how does it work.